When I started with trading, I wondered what actually makes an indicator profitable on the live markets. I used to assume it was all about finding the right indicator, the one secret signal that would unlock profitability. But after testing and using hundreds of indicators, consuming countless videos, books, and even academic papers, I came to a realization. The most profitable approach is not what most people are looking for. And in fact, it's something most traders completely overlook. The first thing is that simple indicators just work better. They have consistently outperformed complex ones when used the right way. You just have to develop strategies that make sense. In other words, ensure that every indicator you use is put to good use. Do not just copy random strategies from the internet that claim to be the holy grail. When I mean simple indicators, I'm talking about moving averages, RSI, Bollinger Bands, bone chain channels, for example. All the basic stuff that everyone says, well, everyone knows, so there's no way it could work. Complex things like machine learning models using neural networks and 20 parameters have a greater risk to overfit. I've explained overfitting in many videos, but as a very short recap, primarily, this is where your indicator, your strategy, or your back testing becomes too tailored to the historical data. So it won't actually work in live trading or out of sample data. Now, the next thing I discovered is something that most traders completely overlook, and that's that every indicator falls into one of four main categories. First, you've got trend indicators, things like moving averages or ADX, and their job is simple. They tell you the direction of the market and how strong that trend actually is. Then you've got momentum indicators like RSI or momentum, which measure how quickly price is moving and whether that move is gaining or losing strength. Next are volatility indicators like Bollinger Bands or ATR. These are especially useful for breakout strategies and position sizing because they tell you whether the market is expanding or contracting. And finally, you've got volume indicators like OBV or volume profile. These help confirm whether a move has real strength behind it or not. Now here's the important part. It's not just about using indicators. It's about matching the right type of indicator to the strategy you're actually trading. Most traders don't do this. They simply stack random indicators on a chart and hope that more confirmation means better trades. But the biggest shift for me came when I stopped relying on individual indicators altogether and started using what's called an ensemble method. The idea is actually very simple. Instead of asking one indicator for an answer, you ask several. Each indicator gives a score, +1 for a long signal, 0 for neutral, and -1 for a short signal. Then you combine all of those scores into one final reading. And that's where things become much more powerful. Instead of reacting to one noisy signal, you're looking at the overall agreement between multiple indicators. That means fewer false entries, more stable signals, smaller drawdowns, and strategies that hold up much better when market conditions change. Then you can take it one step further by sizing your positions based on the strength of that final score. For example, if your combined signal is 0.8, you might take 80% of your normal position size. If it's only 0.2, you risk much less. Instead of using fixed position sizes, your risk automatically adjusts to your confidence in the trade. And when I compared this approach to trading with a single indicator, there really wasn't much of a competition, because the real edge was never finding one perfect indicator. It was combining multiple simple, reliable signals into one stronger decision. There's one more piece that most traders miss, even after they've figured out the four categories and how to combine them. It's not enough to just match the right type of indicator to your strategy. You also need to match it to what the market is actually doing right now. Here's what I mean. A trend indicator like a moving average crossover works great when the market is genuinely trending. But throw that same indicator into a sideways choppy market and it'll whipsaw you to death, generating one false signal after another. The indicator itself isn't broken, it's just being used in the wrong environment. So how do you actually know which environment you're in? You don't need anything complicated for this. A simple volatility percentile, comparing the current ATR to its recent historical range, tells you whether the market is expanding or contracting. And something like the efficiency ratio tells you how directional price movement really is versus just noisy back and forth with no real progress. Combine those two readings and you get a lightweight regime filter. High efficiency, expanding volatility, that's when your trend and momentum indicators earn their keep. Low efficiency, contracting volatility, that's your cue to either sit out or switch over to mean reversion tools instead. This one adjustment, simply knowing when to trust an indicator and when to ignore it completely, prevents more losing trades than switching to a fancier indicator ever will. Because the problem was never the indicator. It was using the right tool in the wrong environment. But this is just one small example of the many different techniques that go into building profitable trading strategies. There are plenty of other concepts just like this.